So with that, Mike,
yes, sir.
You've got control. We've got you connected. You've got sound. I am going to go ahead. You've got 45 minutes.
You got it. Thank you.
Let's go for it. It's all you, Mike. Thanks.
Thank you, sir. Thank you, sir. And I apologize to everyone in the room. I've been doing webinars for over a decade. Never quite had that happen, but so are COVID days. Good to be with you guys today. We'll be going over riding trends with support and resistance. It's a little bit of a build on what Todd spoke about earlier. We're going to break it down to 3 major sections, and I really just want to give you a handle on some of the strategies, some of the techniques that we use to really analyze price action. Tom, great to see you as well. Thank you for that. Before we do, guys, just a quick run through the disclaimer, and I will be right back. All right, so let's jump right in. So again, thanks for everyone who is attending. My name is Michael Boutros, Senior Technical Strategist here with Daily FX. Again, riding trends with support and resistance. So we're going to go over 3 main concepts, and we're going to wrap it up with how we use these 3 tools to construct a trade setup. Now, ideally, we're looking for the convergence, all 3 of these to converge together. But the 3 topics we're going to hit on today are horizontal or lateral levels of support and resistance. We'll go over what those are. You know, swing highs and swing lows are just the tip of the iceberg. Most people will look for support at either a former high or multiple highs being tested, but there's so many more methods and techniques of identifying lateral or horizontal levels of support and resistance where we can look for price inflection. And we'll go over a list of those real quick. We'll then just hit on Fibonacci. You know, I feel like it's a tool that's talked about a lot and a lot of misuses of it. So we're going to go over just the basics of how we utilize retracements, when do we use extensions, what extensions matter, right? And we'll go over a quick summary of that. And then slope. A lot of people will use this word as simple trend. I use slope on purpose. When we're identifying trend, when we're using whether it's trend lines or parallels or pitchforks, what we're doing is looking for the gradient that the market is traveling on. And we'll go over in details on how to use these 3 aspects specifically to identify the proper slope. So let's just jump right in. What are horizontal levels of support and resistance? Well, as I always said, the typical ones they usually look for are major highs and lows, whether it's a yearly high or low or a monthly high or low. Near term, guys, you're looking at weekly highs or lows. The hidden levels that people tend to overlook, the year, month, week opens, where the market opens that session matters. Whether it's the weekly chart, whether it's the yearly, you know, the yearly open will tend to be a major pivot. There's actually many setups that we're talking about right now in markets where the yearly open is sort of that line in the sand, DXY. I'll show you that before the, for all of those of you who stuck around from when I was supposed to present earlier, I'll make sure the wait was worth it. We'll go over some live charts, but the opens tend to be very important levels. High and low closes, okay? Where the market closes after registering a major high or a major low matters, okay? Especially if it's the yearly highs or the yearly low. The close of that day matters. The close of that week matters, right? So the closes, these are just some, you know, you'll see these on all over my charts. HDC, the high day close. LDC, the low day close. HWC, the high week close. LWC, the low week close. So just quick levels that you want to identify on your charts when you're looking to map out support and resistance. Daily reversal resistance and support. On the day where you get a reversal candle, whether it's an outside reversal, whether it's just an inside reversal, what have you, those will tend to be closes of which there's market consensus, right? We stretched into a high, we reversed, we stretched into a low and reversed. Where we close that session matters. They will tend to be technically significant. And then, you know, the more common ones, your longer term moving averages. I personally stick with the 100, 200 day. On the weekly, I would jump to the 52 or 200 week. Not really big, major on moving averages, but they can certainly help in both identifying trend and longer term inflection points. So levels to keep in mind. Finally, opening range highs and lows. For those of you who have been to my webinars on Monday morning, guys, every morning, if anything here tickles your fancy, by the way, on Daily FX, I do the morning weekly strategy webinar at 8:30. We go over the actual practice of all these techniques. So the opening range strategy, typically you're looking at that opening range, whether it's the weekly opening range, the monthly opening range, or the yearly opening range. These range highs and lows can offer also lateral levels of support resistance. So quick summation there. You know, a lot of people look, Marcy's saying audio is good. Okay, do let me know, guys, if you have any issues, please, with the audio. But these are just a quick recap. You know, a lot of people tend to throw out, oh, there's support and resistance here too loosely, right? What is that level based on? It can't just be an intraday high. It can't be an intra-hour high. It's got to be something a little bit more meat behind it. So quick overlook on horizontal levels. Fibonacci, a very near and dear topic to my heart. I've been using Fibonacci for years, and just a quick sequence of what it is. The sequence of numbers is pretty, I think, popular at this point. The Fibonacci sequence is just the previous two numbers added, give you the third. 1 and 2 is 3, 2 and 3 is 5, and so forth. Pretty random set, right? Nothing too fancy about it. For those of you who are math nerds like me, if you look at Pascal's triangle, which is just a basic, follows the same Fibonacci concept of the two numbers giving you the summation of the third. If you take a summation of the diagonals, the Fibonacci sequence comes right out. Every number here is 1.618 times the number previous, and that is the golden ratio, 0.618. You'll hear it referred to as the golden ratio or the key ratio, or a lot of different names for it. And it is something that we use in trading often. Now, what are the Fibonacci ratios, as they're called? 618 is the key ratio. Every ratio you see to the right or left is a derivation of the 618. 618 squared gives you 38.2. Another 618 of that gives you 236. Take the square root of 618 gives you 786. Take the square root of that gives you 88.6, and so forth. Now, you can get down a rabbit hole with this and start getting super granular, the 144 and so forth and so forth. The key ratio is really what you want to be paying most attention to. Now, what is this stuff? Is it witchcraft? Where does this stuff come from to begin with? Turns out Fibonacci is apparent everywhere in nature, whether it's the branching structure of a tree, whether it's the arrangement of a pine cone or sunflower florets, galaxy formation. If you're a surfer, you know the sweet spot of the wave is actually a Fibonacci ratio, right? So it's something that manifests itself everywhere in nature, and it also manifests itself in markets, which is a simple read of market sentiment or crowd psychology. And you'll get these ebbs and flows just as you do in every other natural phenomena where Fibonacci exists. It happens in markets. So what do we use Fibonacci for? There's two main tools that we work with. The most common and probably most widely used is the Fibonacci retracement, right? This is used for fading moves in range-bound markets. If the market makes a rip higher and pulls back, you're looking for where we may find support or resistance on that move. All you're looking for when you're putting on a retracement is two reference points, right? Either a high to a low or a low to a high. Magomed, I hope I'm not slaughtering your name there. Fibonacci calculated with standard deviation of moving average. Do you think it's a good strategy? I'm going to short your name for Mag. I hope you don't mind. I don't have necessarily. I think that's the wrong question, Mag. Right? I'm a big fan of Fibonacci in general. You can use Fibonacci in so many. There's Fibonacci time relations. You can use definitely Fibonacci as a derivation of standard deviation, sure. The real proper question is not, is it a good or bad strategy? It's have you mastered that strategy? I always tell everyone there's no one right way, right, to trade, but there's a million wrong ways, right? And our job is to kind of steer you away from those bad habits and steering into a good habit. I haven't used it enough, Mag, personally, with regards to standard deviation moving averages, but if you're looking at something like Donchian channels or just basic standard deviation channels, sure. Taking a fib of that ratio sometimes can help. Point being, pick your strat and master it. You know what I mean? Master it. There's one problem that the retail trader will typically fall, and I get emails about this all the time, is paralysis by analysis, right? Guys, whenever you're adding a new overlay indicator, whether it's a moving average or a Donchian channel or Fibonacci or trend lines, you want to make sure that it's adding value. It's giving you a tell. You can get into a scenario where charts have MACD, stochastics, so many things. It's called paralysis by analysis. You literally have so many conflicting signals. You end up either being super trigger shy or you never get all of them lined up and you miss many, many opportunities. So pick and choose the tools that you're going to work with and really master them. It's my biggest advice to you. He says, got it. Thanks. I'm more than welcome. Good question. So the retracement is typically your most widely used measurement of Fibonacci. Now the extension, a lot of times you'll hear this called Fibonacci projections, will tend to work better in breakout markets and in broader trend markets, right? Not range bound. Now the difference between an extension and a retracement is where a retracement tells you where within the range we could find support and resistance. The extension projects where we're likely to encounter support or resistance on a breakout or on a trend resumption, okay? The difference is where here we use just a high and a low, here we use 3 reference points. Again, if you're in a bullish market, you're looking for a low, high, low, and I'll show you examples of these in just a moment. In bearish markets, you're looking for a high, low, high. And when you've taken those 3 reference points, it'll give you the projection. So let me show you an example of each. Here's a Fibonacci retracement. This was on euro dollar back into the open of 2018. Market had rallied from 104 into 124 just a little over a year. And we had this nice trend consolidation, nice little breakout to the downside, right, for a little consolidation. So the first tool or the first rule when you're using fibs, the reference points need to matter. So I think we would all agree this is a pretty concerted low, pretty important multi-year low, right? And at this point, we've made a break of uptrend resistance, support, shifts the focus to the drop. So the focus is on this range, this advance. Take your low, stretch it to a high, and your Fibonacci levels come out, okay? Now, one little caveat I want to say on the side, I have here the 50 line removed just for principle purposes. So the 50 level is not a true Fibonacci level. It's not a derivation of the 618. There's no way you can math your way into it, but it's very often sometimes that markets will either see inflection, support, or resistance on half of the advance or decline. So I'll show you an example actually where the 50 is a great level to look at. But right here, for all intents and purposes, your first major levels, your 236. If you get a break there, you're looking for the 38.2. If you get a break there, you're looking for the 618. Well, the 236 broke. Here's the 38.2. This was a weekly chart. Once you get a weekly close or a daily close below that level, you might get a lot more jargon, but the focus is lower, right? Next level is 119.94 or 111.94, excuse me, and we hit that into the open of 2019. So a cherry-picked example, but just a conceptual way to graphically see how the retracement would be a benefit to us while we're in a trade, while we're looking for new trades, right? As you're heading through these levels, bearish guys, we're taking some off. We're taking some off, stops go break even or better. We're taking some off, stops go even deeper or better, right? For people who are looking for new or reversal trades, you're looking for this to hold. Let me see if I get it bounced. Doesn't happen. What's your next level down? Looking for a hold here. That didn't happen. What's your next level down? There it is. What's an example of an extension? When do we use extensions? Well, here's an example of euro pound. This goes back a few years, but was such a stellar example. You had this multi-month consolidation pattern, right? Price was contracting. You see a series of higher lows, a series of lower highs, and you're looking for the breakout. An extension here using a high, low, high yields your downside objectives. Now, again, I'm jumping ahead of the presentation here, but what we're looking for, the ideal plays, are the convergences. Where do lateral support or resistance converge on slope? Well, in this example, the 50 line was a perfect confluence region. Now, why does that confluence region matter? Like, what does that mean? At the end of the day, these are areas of what I like to call low tolerance. I don't want to see price sit here and meander. I don't want to see chop. If it's going to break, the break should be accelerated. If it's going to hold, the rebound should be rather momentous, right? Should be a strong inflection. In this cherry-picked example, again, the break not only materialized, we came back the next week, checked it as resistance again, and moved right off. And you can see in this example, even longer-term moving averages are, offered again that confluence zones of where, wow, if this breaks, something's got to happen, right? Something's got to happen. So an example of fib retracements and extensions, we'll come back to example and we'll look at live examples in the markets if we have time. But I want to move on. Quick note on basic trend lines. I know that Todd touched on this briefly, but when we're looking for trends, what are we doing? Again, we're identifying the gradient or the plane that the market is traveling on. Very simply put, the trend, right? You'll hear it often say the trend is your friend, but that's just identifying the trend, or I guess your friend, is just a small portion of what we're trying to do when we're analyzing these price charts. So we're looking for the original slope. Parallels off that slope will give you great inflection points. And this is the basis of channeling, right? You take a support trend line off the lows or resistance trend lines off the highs. That always could be the original slope. Parallels will continue to pay off dividends when extended off of major highs and lows. And again, I'll show you examples of all this in a moment. Finally, pitchforks. I could do, guys, a whole presentation on just pitchforks, certainly a major part of my analysis. All a pitchfork is doing is helping you identify that same slope that we're doing with basic trend lines. So I always tell people, don't stress the reference points, stress the slope. And so what does this all mean, right? It's all good to talk about conceptually, but seeing is believing. Let's look at some real charts. Here's a chart of the DXY. I can't stress to you how critical this slope has been in DXY. This same trend line has been instrumental in so many different trades, and I'll show you the live charts in a moment. But the basics of trend lines, right? 2 reference points give you the slope. The one thing you always want to keep in mind with trend lines is 2 points is speculative, 3 points is confirmed. Remember, any 2 highs can make a trend line. I can go around making trend lines off of every single high I see, and I'm just chasing rainbows. It's the first test of that slope that confirms, hey, do these levels even matter, right? So on the third test, that's the first test of whether it is an actual trend line of merit. And here we saw not only one test, but another test and a third test. And you can see that every subsequent test sees stronger rebounds as we continue on that slope. This is the original slope. Same trade, pushed out a couple more weeks. What happened? We went for another test into the mid-2017s. Here's the break. What happens? As trendline support breaks, becomes instant resistance. So here it is, testing again, even a higher test before inevitably moving lower. Technical analysis 101, trendline break support becomes resistance. The one thing, again, I want to just continue to hearken and hammer home. Every tests of these major slopes, of these original slopes, should have a strong inflection in price. And the stronger the inflection, the more conviction we have on the trade. Here's another Aussie Kiwi trade. For those of you who've been in the webinars for a couple of years, you remember this one. This paid out for like another 3 years. It just continued every test, just these 2 reference points. Third point confirmed. On the break, acceleration, right? Strong test, strong test, strong test, break, acceleration. Support, support, support. So even when the line breaks, even when the slope is invalidated and shifts your focus lower, you keep that gradient on there, okay? Until it pays no more, until the markets are not paying attention, until the inflection points aren't inflection points and you're kind of sailing through it. But the efficacy, it's insane to look at a chart like this and to think that we had this gradient nailed just from these 2 reference points, confirmed on the 3rd. So quick tidbit there on trend lines. So parallels. Here's an example of an Aussie dollar trade. And I'm going to use this same example to show you how we're not only measuring slope, but pitchforks are going to do the same exact thing. So here's a trend line connecting the 2 highs that we saw in Aussie on the rally into 2016, right? Just basic 2 highs within the advance. A parallel of that line extended off the low gives you this gradient. Now again, it's a ways off, right? It's like a 500 pip move, but eventually the market found support right there. And it's that simple, guys. A lot of people will look at this and be like, Mike, that's witchcraft. Things don't really work like that. I'll show you the live charts. Again, you can't make this stuff up. That support line gave a nice little rebound in price, which eventually traveled higher. Now, is there a way where I could have gotten this same gradient using another tool, maybe ahead of time? And that's where the pitchfork comes into play. Same trade, guys. Here it is, same advance. If we had taken the low, high, low, because we're looking for the rally, we would have gotten this gradient well before price even broke out. Okay. Your basics for pitchfork analysis. A break of the median line looks for a tag of the upper parallels. A break of the median line to the downside looks for a tag of the lower parallels. The median line is to be used as an inflection, resistance, or support zone. From the way down, support, on the way up, resistance, resistance, resistance. Remember, markets don't work in a vacuum. You're going to get these days where you get emotional market spikes, and we might even close above it. We always have to practice risk management. I was just listening to Chris's, Mr. Vecchio's slot earlier, and he's absolutely right, guys. As a trader, your #1 job is capital preservation. So at all times, even when it seems like we got a daily close above, the breakout is in hand, no. We still have to practice good risk management. A lot of times it'll be the washout that resets the setup. So just a way that we can visually see how a pitchfork may have given us a little bit of a heads up on that slope. So some things to take away with pitchforks before we jump into some live charts here. In an uptrend, remember your reference points should be a low, high, low. In a downtrend, you're looking for a high, low, high. When prices approach the median line, which is the buy sector, you're looking for a reversal or inflection, or if it breaks, you're looking for a tag of the opposite median line. If it's on the upside, median line resistance. If it's on the downside, median line support. As always, stress the slope, not the reference points. Sometimes it's not going to be the actual high, low, high, right? Sometimes it might be a secondary high or low. The main focus, guys, is that as price approaches that gradient, we're seeing inflection. We're seeing a price response. And that's all we're focused on when we're studying price action. So a couple of more examples, again, cherry-picked examples. So what is a great way to use pitchforks when doing 5-minute binaries while combining EMA, MACD, and Bollinger Bands? So Francis, You can use pitchforks and slope analysis for that matter on any time frame. But with a capital B and a capital UT, you want to make sure, Francis, the smaller the time frame, the lesser the magnitude of the break. Meaning, if I'm looking at a 5-minute pitchfork and it breaks lower, the expectation for the follow through on that move shouldn't be the same as a daily pitchfork that just broke lower. So it's always important to take into account, excuse me, guys, not only what time frame you're looking at, but what the expectation is for the trade. And that's derived mostly by what time frame chart you're looking at, right? So I hope that answers your question with regards to the time frame. But as in line with that question, here's an example of a trade. I think this was Euro Oz back in the day, right? We had a longer term weekly chart showing us a move lower into confluence support. Why is it confluence support? Well, it's basic lateral support. It was the April lows. So basic swing low and trend support. Basic trend line resistance. We got a third test, so that held. If we took a parallel of that, it looks like these two were perfect tags. Here we are again. So you have lateral support and downtrend support. Let's zoom in, right? Let's zoom in. Here's what it looks like. It's important that we break downtrend resistance before you ever try to fade a move opposite the trend, right? No one's going to argue with me. This is in a downtrend, right? Same thing here. This is in a downtrend, but we are at downtrend support. So we have a near-term structure here as we zoom into the 2-hour chart. Here's channel resistance. Here's a parallel of that, gave me 2 touches, so I have a little more conviction. This is going to be the first touch. I don't know if this slope has any merits, but if it does, here's the pitchfork, low, high, low, and there's your gradient. If we do break, initial target, secondary target. And again, when we did breach, cherry-picked example, you have your levels lined up. The median line is always going to be your first level. There's the upper parallel. And again, on the break, median line resistance held. There's the break, acceleration right into the upper parallel. One little tidbit a lot of people will tend to overlook in technicals is when a market breaks uptrend resistance, that can typically be the sharpest part of the rally. All the people who are already long, they see that break, okay, yeah, I think we should jump. That's not when that's actually when the market typically has the most push. Same thing with a break of downtrend support. Typically that can be the sharpest part of the decline. So I digress. A look here at how we would approach using a pitchfork within the confines of the broader picture of a trend. So convergence, confluence regions. We're looking for where lateral support and resistance converge on slope. So you've identified the lateral region. You've identified what levels matter. Slope adds what? The time value. Not only where does that price matter, when will that price matter? And that's what we're trying to derive when we find the convergences or the confluences of both slope and resistance. So you look for decisive moves off these regions. Again, no dilly-dallying, right? If we break through, you look for an accelerated run. If we reject, you look for a more significant reversal or recovery. These confluence regions can oftentimes be the most attractive risk-reward ratios because what is the objective when we're trading, guys? As a rule of thumb, if you're wrong, you want to be wrong fast. I want to be wrong quick. I don't want to sit in a losing trade and stare at it. If I'm going to be wrong, I want to be out quick, right? And these are the trades where you're looking for inflection. We're expecting the markets to give us some sort of pivot. I don't necessarily know if it's going to hold or break, but I know I'm looking for something here. And again, attractive risk to reward ratios are always the name of the game. So again, it works on a lot of time frames, although the longer term charts, like I typically say, will yield more significant moves, you know, a break. And I'll show you the DXY chart, just amazing how that's continued to pan out. But the breaks of monthly or weekly trends, those will run a little bit, right? Even if you get weekly recoveries, the broader trend is in play. Hi, Mike. Is the pitchfork still applicable to ranging markets? Absolutely, Roland. It depends on, it's good to see you in the room here, by the way. It depends on magnitude of trend, right? So we could be in a ranging market on the monthly scale. We can be in a ranging market on the weekly scale. Intraday, you're still going to get ebbs and flows, rallies and pullbacks within that market. So you typically don't want to look for a pitchfork, Roland, generally speaking, in a range market. But if you're zooming in, you're going tighter time frame, absolutely. Within that range, there'll be ascents, there'll be declines, and the like. You know, if I go back to this example, I could argue, you know, if we take, well, I guess this is not a very good example, but if we were to take any range-bound condition here, within that range, you still have magnitudes of trend, right? So I hope that answers your question. Roland, let me know if you have any further questions on that. He says, makes sense. Okay, cool. Okay, cool. So nothing, again, seeing is believing. Let's jump through some examples and get a deeper look here on how these things play out in real practice. So here is dollar CAD. We were rallying into the open of 2019 or heading into the open of 2019. We were at lateral resistance, the June high day close. So whereas people are looking for the swing high, right? Here's the high day close. So if we break here, maybe you get that little heads up ahead of people who are looking for the high, right? By the way, why do high day closes matter? That's a good question. It's a day where there's market consensus. Once we reach a record or push to a record high or a record low, where we close that session matters. So not only that, guys, investors, longer term investors, money managers, they're looking at the close rates. They're looking at line charts. They're not even looking at intraday. So a line chart will automatically, that high will be usually typically the high day close or the low day close, right? So you're looking for a breach. If it breaches through the median line, your initial level is a 618 Fibonacci level, converts on the 2017 high day close. And again, a lot of times the high day, guys, the close will be so far out. A lot of people, it's just a hidden level. What happened? Well, when it did breach, finally, did see a little bit of a hang up at the median line, but look what happened at that lateral support level, or former resistance, now was support. Once we break, you get the daily close above. We're looking for that one-way trip towards 3685, 3647. Lo and behold, into the open of 2019, that's where this thing was grinding resistance. So what are you doing here? What are you doing up here? Well, if you're long, if you've been playing the breakout, you're taking some off the table. You're definitely bringing your stops break even or better. Anytime, by the way, just as a caveat, my humble opinion, anytime you take a trade off, guys, or you take a portion of the trade off, you better be bringing that stop in. It's just nonsensical. I don't understand how people do it. They'll take a little off the trade, but they'll still leave their stop 50 pips out. Well, that's going to skew all sorts of risk reward measurements. So you're taking a little off the table, you're bringing your stops up. If you're looking for new opportunity, well, if we're going to find inflection, this would be the place to look. You might be asking yourself, what's this line here that you're looking at? It's a parallel, but not just any parallel. That's the 618 parallel of this pitchfork. So Fibonacci, once again, carrying over, right? Where you can use that key ratio, even in slope, guys, in time, in price. So does Nadex charting platform have pitchforks? Michael, I'm pretty sure it does. Tom asking, you're asking for the DXY. I'll show you the chart in a moment, Tom. He says, I can't wait for your next Monday webinar. I'm actually off next week, Tom, so we're not going to be on this Monday, but the following Monday. So if we have time, I'll squeeze in the live chart in a moment, sure. So anyway, long story short, guys, this one played out real well. You saw resistance hold there. Where's your first support level? Well, right back at the median line. Now, wait a second. As soon as this turned, what could we have added and what I show you here in the report? Well, now you're looking at a range. You have a well-defined low at trend support. You have a singular move into a high. Looks pretty convincing to me that we've made a near-term high. Here's your retracement. Look for the confluence zones, So that means this break should yield something. If it breaks, I don't want to see price meander, something like this. If it breaks, I want a shot down. If it's going to hold, I want a strong inflection higher. Well, the break happens, and you're looking for automatically a run into the 38.2. Key support is the confluence of the 618 and major uptrend support. Trade continues. We break below the 38.2. There's your retracement, right? Looks like the market's petering out. What do I do? If I'm in a short from like 35, what do I do here? Do I just leave my limit here and stop at 35? No. Dynamics in your analysis. As price responds, so does our analysis. So a near-term low looks to be playing in place. How deep's the recovery going to get? New retracement. You got a high, you got a low. Your first level is the 38.2. I want to see if 33.65 holds. That's my first level. If that breaks, might be a bigger recovery, right? Maybe I put my stops just above that 38.2. I'm not willing to sit and lose that much profit, but you have those levels mapped out. Well, market rallied into that 38.2, stop traffic, turned lower. Again, story's not over, guys. The story's not over. I still can't just go blindly chasing this. Now what do I have? I have a breakout market. I have a trending market. I have a low, high, low. Let's scrub this extension or this retracement and add an extension. The 618 extension pushed it down just a little bit from 31.19 down to 30.75. Obviously, again, the break materialized in the days to come, and we finally did get a drop into that confluence support. Again, a parallel of the same gradient slammed right into it at 30.75 before rebounding. So just a new way to kind of really just let it settle in of how we work these levels through a setup. So here's the big whopper, my favorite example. I just wanted to go over the DXY. I saw your question earlier, Tom. Again, I can't get too details, but I'm definitely going to jump in here. I'm new to this and came to this webinar late, but it is pitchforks. Yes, Romulus, good to see you. Good to see you. So this one's going to blow your mind. Here's basic trendline support of the 2011, 2014 lows in the DXY. Okay, literally 7, 8 years later, this same slope is in play. What happens here? Well, we have two lows. If I take a parallel, extend it off the high, right? I'm looking for resistance up here on the rally. If this breaks, what did we say earlier? A breach of uptrend resistance should be the sharpest part of the rally. Well, when that broke, and it was a messy break, boy, did we see a rally. This thing continued to rip into 2015, obviously. Massive, we had a nice little consolidation region here before finally breaking lower. A nice range was in play. On the break lower, right? Where should we look for support? Former slope resistance, turn support. Well, you can't make this stuff up. It slammed right in there into the early first quarter 2016 before ripping higher. Game wasn't over yet. The slope still had more. If we take that same parallel, extend it to the most recent high, you're looking for resistance along that plane. Well, we didn't quite make it that high, but it got pretty close. It got pretty close before failure, starting to pull off. Where's support? Right at that trend. That's your potential support level. When it broke, confirmed the broader turn in the dollar, and we're still dealing with the ramifications of this, guys, now. Resistance, There was resistance again. And now that's your new resistance level. Continue to hold, continue to hold, continue to hold, continue to hold before finally making a move on the breakout into 2020. Where did it fail? Again, you can't make this stuff up. 2016, high close, okay? A little bit different of an animal, not just the high day close, but the high close, which was a little bit higher than the actual high day close, was right there at 102.99. That's exactly where the COVID rally failed. And so all year long, we were talking about, listen, 91.91 gives out. This is pretty problematic for the DXY. Well, came into it September of last year, strong rebound before finally breaking down into the close of last year. So what do we do now? Well, looks to me like I have a high, low, high, tack on a big pitchfork, and it'll give us some gradient for the decline. So what does this mean? Well, a retracement of that 2011 advance, guys, gives you the 50 at 88.18. Downslope support is there at 88.18. I'll show you the live chart in a moment. A hidden level, and I just talked to you guys about it today. You know what ended up catching the lows, off by 13 pips, by the way, was the low week reversal close. Here's the live chart now for DXY. Low week reversal close right here at 89.07. The low was 89.20. Unreal, right? So here's the recovery again on building divergence, price action lower low, throw some momentum, studies on there, and we're looking for the recovery. If this recovery is legit, and we're talking now market outlook, guys, not a trade recommendation from Daily FX or IG or Nadex, it's my humble opinion. If the dollar has put in a more significant low with this recent recovery, this is the weekly chart, by the way, weekly open support should hold at 89.93. So on any pullbacks we get on the DXY specifically over the next couple of weeks, as long as 89.93 holds on a weekly closed basis, you're looking at the threat of a larger dollar recovery. This is the weekly chart. You can zoom it into the daily chart, right? Here's the daily chart of the DXY. Weekly coming into support. How do I know what upside to play? Well, here's the nature of the decline. Here's your high, low, high from August and September. There's the lower parallel, catching support, catching support, catching support. Here's near-term resistance at 91.01. Again, if this legit bounce, if this is a more significant bounce, there's your monthly open at 89.93. All right, so a quick flavor there of how we use this. Now, even deeper than this, guys, again, for those of you who know my strategy, I'm much more near term. Even deeper than this, what does this ascent look like? Well, that's where the near term charts come in. And this is what we do every Monday morning on the scalping webinar and Daily FX, guys, at 8:30. We walk through every single one of these setups for the week for what we're looking at. And here's the nature, a low, high, low in the DXY for the advance. Look at median line resistance. Look at median line resistance, nuts. Okay, so quick recap of the confluence zone idea. It's nailing down lateral support and resistance with slope. And the whole concept is for us to be able to be not only acknowledge the levels that matter in price, but when do those levels matter? And that's what slope helps you identify. Okay, so just some quick notes there. Oftentimes will be your most favorable risk to rewards, very attractive because you're coming up against major levels, and it helps you again put a time value on the level. Whereas I know 91.03 is big, I know it's going to be exceptionally more significant as it converges on that slope and price approaches that region. So I hope I didn't get too deep in the weeds with you here today, guys. What time is that daily show and how much does it cost? Michael, it's free and it's on Daily FX every Monday morning at 8:30 Eastern. For those of you who are interested, you can always find our authors page. Chris spoke earlier. Here I am on every single one of my reports, guys. You'll see that link for the webinar every Monday morning. Again, 12:30 GMT, 8:30 Eastern. Take questions just as we do here live, and try to really put together the ideas and concepts and setups we'll be looking in the week ahead. So I hope you guys enjoyed. Again, I want to thank everyone's attendance. I love doing these expos. I apologize about the sound and difficulty we had with the technicals earlier, guys. Hope you enjoyed the show, and I will turn it over back to Todd.